Hi, welcome back to Academic Market Insights with Dr. Russell Rhodes with Dr. Larissa Demiak. We're doing a series on what I call volatility events, but what most people call market crashes. And we started out, you can see the previous videos probably in order just behind this one below somewhere. But we started out talking about long-term capital management, which was kind of a firm specific event that we didn't know the term too big to fail yet, but it was a too big to fail incident. This is a more interesting one and may relate to some of the things that are going on right now. We'll get to that, I promise. But we're going to talk about the dot-com bubble, which just before I hit record, I made the comment that it was 25 years ago. In that,
And I have to say, neither of us truly remember this event.
you might not. I do.
I do.
I do.
I definitely do.
I most definitely do. Yeah, you were.
Yeah.
I'm doing math in my head because I know how old you are.
Oh,
Yeah,
yeah. No,
you
I
were
do.
around for it as well. So,
And my first job out of undergrad was dealing with compliance. So, it's just one of those things that it really was a big impact.
no.
So, having said that, let's jump into the deck. And now we're going to take a look at the dot-com market crash. So this happened, and we're going to talk a little bit about the dot-com crash, and then we unfortunately also need to talk about 9/11 within this because they're so closely
Yeah.
related. And we'll see it in the data. Okay. So we got to set up the story, right? We got to paint the picture. Um, Late 90s. We have all of a sudden the surge in technology with the internet. I remember when I started at university, I got my first email address. Woohoo! This was also the time of the craze of the beanie bags. The little toys, the beanie bags, babies, beanie babies, that's what they are. So we've got this weird, like glamorous time to be in the markets. The markets were not as well, they weren't as regulated,
They
but
weren't in.
two, they were also not as efficient. So as a result, it was a very good time to be a trader.
Oh,
It
yeah.
was a very good time to be an analyst. So you've got this surge of money coming in. We've got people coming off of the excess of the 80s and coming or bouncing back from the 87 crash. And people are really wanting to put their money to work.
Mhm.
So it was kind of not kind of, it was a very exciting time in the markets. And again, we're going to talk about the changes in regulation. This was a time when equity analysts and CEOs could hang out and become buddies.
Oh,
And
I know a certain CEO of Microsoft that was enamored with an analyst, and you would always listen to her when she said things about Microsoft. She was definitely
because
the, as we would put it, the axe in Microsoft. Uh,
got it.
yeah. If you've ever heard a story of Bill Gates jumping over a chair to impress a girl at dinner, that was
This was
part
an
of
equity
that was
analyst.
yeah. And then after she said that's great, she said, "So what are the next quarter numbers going to be?"
Oh yeah.
But there was a lot of interaction that does not occur in this day due to new regulations for sure.
And so this isn't in the deck, but I think this is an important point to point out. When we think the reason why this is so important is if, as an equity analyst, I put out an estimate of $3, but I know that it should be 325, what happens to the stock? So I put out three. I know it's going to be 325.
It
What
comes in
happens?
at 325.
And comes in at 325. What does the market do?
Yeah, well,
It
it
rallies,
goes
right?
up, but we started to get smart about it after time.
But
You
there was
know,
a
but
time
yeah,
period where it was great.
yeah,
And it might not be as wide of a gap as a quarter, but even 2 or 3 cents can make a substantial reaction in the markets.
yeah.
And often it would be an overreaction.
Mhm.
So it was in a CEO's best interest to make sure that the equity analysts were in line with what they're going to do. Because they want to give guidance to investors and say, hey, we're doing really well. You should be interested in us. As an analyst, analysts would be able to get usually some kickbacks.
Yeah, they may. You and I are both working on CFA challenge teams right now, and we have our teams putting models together. And periodically, I might say something like, maybe we want to make sales a little bit less aggressive in a couple of years because that would be about time for another market slowdown. Or we start throwing things out there based on our experience. What the company would do is say, our expenses might be a little bit higher than that. You may be too aggressive on sale. I mean, they would give them some guidance as to what their model looked like relative to what they were seeing internally. They don't do that. They're not allowed to do that anymore. So,
And as from the analyst's perspective, then if they have better models that come in, they're going to be noticed by their superiors and promoted within the business.
mhm,
Um, but also there were kickbacks during this time period.
mhm.
So, for example, I love to vacation in Hawaii, and as a CEO, you might be willing to take me out for a dinner in Hawaii. And I'd be
Yeah.
like, well, I like to surf. Okay, we'll throw surfing on the agenda, right? And these are things that no longer happen.
Mhm.
Absolutely not. There is a wall that separates analysts from those people. So the glory days of the 90s. So this is ushering in, and we've got this new technology with .com, with
Mhm.
internet. And I don't know about your first experiences with the internet, but I at first was just a little bewildered on how to use it. I remember when I think Amazon started, and I
Mhm.
remember thinking, who wants to buy books online? And it was just such a bizarre concept to me.
It did, and I'll tell you, the one that really got me was eBay. Like,
Oh,
how do I
yeah,
really know somebody going to send me something if I send them money? That
right.
really was the one. I'm like, this is just an opportunity for criminals.
And I
And it
believe it
still
ended up,
is. They can.
it's still, yeah,
Where do you think the items when they do a smash and grab in Chicago? Where do you think those items end up?
sure.
On the eBay. Yeah. So, ooh.
So, again, this is NASDAQ, and this information comes from Alfred, which is the archived version of the Federal Reserve economic data as hosted by the St. Louis Fed. And what we can see is in the late 90s, we've got this nice rise, ding, 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 ding. And then we do see a crash from 2000 to 2001. And right here is where 9/11 hits.
Mhm.
So, and so again, you can see the full swing, and it took us a while to really recover from this.
Oh, it took years for us to get back. I mean, I know the S&P 500 and maybe even the Russell 2000, the Dow, they all recovered their dot-com highs, you know, within a reasonable time. But I feel like it may have taken even a decade, if memory is serving me right, on how long it took for us to get back from back to the all-time back to that 5,000 level that it touched and then fell off of.
Well, and it's funny you should bring that up because, we're in this kick right now of talking about these volatility events. And if we think back to a 10-year swing, that would put us at, so 1998 to 2008. So we hit another economic crisis or volatility crisis. We also
Mhm.
had a crisis in 2005 with housing prices. So we have seen this quite a bit, and it was a tumultuous decade to finally get
Mhm.
back and above it.
I talked to my best friend ChatGPT while you were just talking. It was 16 years.
Holy
It was
smokes.
2016 was when it finally got back. I know it. I know it was at least a decade. So
It
yeah,
took a while. Well, and again, we suffered several other
yeah,
crashes in between.
yeah.
So some of the issues that came out was we had this overvaluation and we had corruption. We had substantial amounts of corruption. I want to say some of the tyrants that we saw from the corporate uh, uh, corruption.
Mhm.
Enron. they're the ones that use these SPV, special purpose vehicles. And what these little babies did was they allowed Enron to set up a shell company, and they would be able to remove that asset off of their balance sheet. So if they had a stinky asset, they were like, we don't want anybody to see this. They could remove it. This shell company then would replace that asset with cash. So all of a sudden now we are looking at a much healthier, much more robust, uh, what is it, balance sheet. And this is what would be put out there. And some of these SPVs would be maybe overnight, maybe a week. And one of the favorite things, and it's Jeff Schilling, not Tom Schilling. For those in the Chicagoland area, yes, they are. He is brothers with one of our favorite weathermen in Channel 9.
Skilling.
Skilling,
Yeah,
thank you,
yeah.
Skilling. Yeah.
Unfortunately, Tom Skilling, and I have a special place in my heart for Tom Skilling because my daughter is majoring in meteorology, and he like sent her an encouraging note before she started on that, even though he's retired here in Chicago. But his brother was the CEO, and I think while it was in the news, he actually took a little bit of a break, which is unfortunate because that wasn't his fault.
No.
What I thought you were going to say about Enron was the funny names of the SPVs.
Oh, I know. One of my favorite names.
Juco, which is Chewbacca. One of them is LJM.
I was
I
just
don't
gonna say
really
that's my
know
favorite
where
one.
that came from.
So my
Um,
maiden name is
it has
Miller.
nothing. But yeah, it's really irritating when two people are sharing an inside joke. That is Dr. Ademiak's original initials before she got married, was LJM. And she used to have a badge that said LJM. They had JEDI, which was Joint Energy Development Investments. The Raptors, they just made up silly, silly, silly names. I knew there was something Star Wars oriented in some of the names. But I
And
mean, how in the world did it? And this, I mean, that ended up affecting their auditor as well. But how do you not pick up on something that's named Jedi?
I think their auditors at the time turned a blind eye.
They didn't want to
They
because
did not
who's
want to see
paying them
it.
to be the auditor?
I think it was Arthur Anderson was
No,
the,
no, but I mean, Enron's paying Arthur Anderson to be
oh
the
yeah.
auditor, and if Arthur, much like the credit ratings on mortgage bonds, if we don't give you the credit rating you want, we're going to go across the street. If the auditor starts calling Enron out, yeah, they can just go find another auditor.
And at the time, I believe there was it was the Big Six.
Yeah,
Uh,
it's down to four. It's much like college football, it's down to four now. But
it's down to four. So the Big Six refers to the largest accounting firms who would do audits. So we've got lots of things happening, and I want to say the woman in charge of um, of the SPVs, and I'm drawing a blank on her name, but she was given a nickname in reference to one of the Ayn Rand books. So I want to say she was called Dagny Taggart.
Agni Taggart,
Um, yep, from
yeah,
when Atlas
yeah,
Shrugged. Yep.
yeah.
So very, pistol, very focused on, manipulating those lines.
Hmm.
And one of the things that Mr. Skilling, not Schilling, Mr. Skilling said was, I don't know what the accounting team is doing. And that was his defense the entire time. I don't know what the accounting team is doing. I don't see what they're doing. And and it's not mentioned at the end of this deck, but one of the things now CEOs have to sign off and say, I know what's in this report. So if I publish as a CEO a financial report, I'm saying I actually know what's in there. This is not a fictitious. But some of these tyrants were out there manipulating numbers, and we care about this. And this is what's really important, is because so many people's livelihoods were tied up. So if
Yeah.
you were somebody investing in Enron and your 401k was tied up to this and Enron goes under, your account is wiped out. Okay, so it actually is one of the reasons why this matters in these types of things. So we have lots of corporate corruption,
Hmm.
and it's all about chasing those excess gains, right? So if Microsoft is putting out 15% return, you're Enron, you're looking to put out 15% return. Whether you can or can't is irrelevant.
Yeah.
You just want to keep up with what everybody else is doing around.
No, the fun, really just a quick fun story about Enron. You can go ahead to our buddy, the pets.com sock bucket, who actually got purchased.
Mhm.
The puppet did. I just love this. During Enron's, probably their last earnings call, there was a buy side analyst, and the buy side analysts are the ones that are actually putting money to work. He's a guy from Highland Capital Management. And he asked why there was no balance sheet provided along with the income statement when they reported their earnings. And Skilling's response, usually they say, "Thank you very much for that question," and then get into it. He said, "Well, thank you very much. We appreciate that, asshole." And then if the CEO ever curses at a question on the call, short the stock. And we're not here to make
Immediately.
recommendations, but there. All right, I'll let you talk about the pet. I can't remember what this pet sock. I can't remember the sock puppet's name.
I can't remember his name either. So again, confusion around the internet. And this is where the .com comes into it. And at the time, I was fairly young and very new into the career. And I remember thinking, I don't get it. I don't see how people are going to make money. This was before Google had, I know,
Is there another area that people may not make money right now? Okay,
may
all right.
not. And to put things in perspective, okay, so
Uh-huh.
Amazon's brand new. They only sell books, right?
Yeah.
Um, pets.com, which we will talk about, comes on. I remember when Google came out, I want to say Google came out in 98, 99. I want to say it was 98. And Google didn't have AdWords. There were no, there was nothing to Google. It was just seriously that
That was the beautiful thing about it versus Yahoo.
yeah.
Yahoo search, you get like three ad things. Google search, it's actual search. Google
Mhm.
search now, you get three ad things. I
Yeah,
mean,
I
now that
know.
so you got to go to like DuckDuckGo, DuckDuckGo,
Duck, duck, go.
DuckDuckGo, I think. Yeah. So
And so this was a time where people hadn't figured out how to monetize websites. I want to say it was Bill Gates who did an interview in the late 90s, and he talked about his future vision for what technology would look like and how it'd shape our lives. And he talked about travel. And he said people aren't going to go to travel agents anymore. They're going to just book everything online. And I remember hearing this at the time and I thought, that's just crazy.
yeah, no,
How could you possibly do that?
the when the first iPhone was coming out and they would talk about your ticket's going to be on your phone. And I may have been one of the last old guys that would only use paper tickets whenever I boarded a flight.
Because
I,
it just,
I don't
yeah.
think I think you barely see anybody using a paper ticket now, unless you're traveling with kids or something like that.
Yeah,
But
as I say, I use
and
it. I do.
and I am you know that I just moved. I have a gigantic jar of ticket stubs from all the things that I've gone to. I have like 20 ticket stubs from the Atlanta Olympics, all these different things. You don't have anything cool like that to save anymore when you go to a sporting event. I kind of miss the tickets, but
I like the
I almost feel like at some point, maybe when I have grandkids, I'll take them to something. And if there's actually paper tickets, they're going to ask me, what that is, like my kids ask me what a rotary phone is.
sure.
It's the same thing.
It's the
So
same thing.
yeah, no, that was kind of mine. And then you talked about your first email address. I just got to mention, when I was an undergrad, they gave us email addresses. They were our social security numbers at.
Oh
Yeah, the first one I was ever given was my social security number at, but it was supposed to be only used to turn in homework in one class. But we figured out we could email each other. I mean, we figured out how to use it and figured out that we could message each other as well. But that my first email address was my social security. at I think Memphis State University.com, .edu or something like that. But
Well, it's funny. So my first email address, now that you're saying it, was ljmst32 at pitt.edu.
okay.
So my initials, student, and I must have been
Oh,
32nd student with those initials since the inception of the system.
no, those were the great days. Now that's how you tell how old somebody is if they don't
Yeah.
have numbers with their email address. They actually have their
So
name. Sorry.
pets.com comes along
Uh-huh.
and there's no way to make money. But it was a publicly traded company and people were pouring money into it. And similar to Amazon, Amazon for the longest time didn't turn a profit, but investors kept investing. And to Jeff Bezos' credit, he knew that his goal was to become big. So he wasn't worried about the fact that they weren't turning profit. He wasn't worried about any of those things. He said, we need to be first and we need to be biggest. And again, decades later, obviously, it's substantially paid off. But in the beginning, I remember thinking, why would anybody ever invest in this company? They don't have profits. So we've got companies that were coming out that people were investing in and they don't have profits.
Yeah.
Dr.
They
Rowe,
ba-
how is
they barely had
that
sales.
possible? And
We
they didn't.
it was one of the first time it was there are a few things that valuation wise came out of the internet bubble, and one of them was using price to sales. It really
Mm,
was. And early versions of cash flow analysis
mm.
because you weren't expecting any, you were expecting burn, burn, burn. I mean, I think a lot of us learned the phrase burn rate with public internet companies. And first off, public companies shouldn't have a burn rate.
Nope.
They really shouldn't. They should, a lot of companies were going public much earlier than they should have. And it was just because if somebody's going to throw a bunch of money at you for your business idea, why the heck not?
Yeah. So the CEOs of those companies made a substantial amount of money when they went public. And
Hmm.
I don't blame them. And people, and this was also the rise of the expression a greater fool, right? And the idea is as long as there's a greater fool than you to buy the asset, you're doing okay. You just can't be the last one with the hot potato. So we also not only we have corporate greed, we have corporate problems, we've got companies that aren't making money. We also weirdly have this surge of day trading. And so again, to paint the picture, in the 90s, if you wanted to make a trade before the internet, if you wanted to make a trade, you were calling up a broker. And that broker then would go ahead and execute the trade for you. You want to get out of that trade, you call a
Hmm.
broker. This was incredibly expensive and time consuming to trade. All of a sudden, you've got access to the markets, and it wasn't free to trade. I remember when I set up Equity Steward Investments, and was looking around for different rates for trading. Fidelity was able to give me $20 in and $20 out. They waived quite a bit of the fees for you. But I mean,
I
that's
know. I just,
$40 round trip. Could you
yeah.
imagine paying $40 round trip? And now all of a sudden you have these people, and it was mostly middle-aged engineers
Hmm.
who would on the side start day trading. And
Yeah.
you've got these stories. Remember, pets.com, Amazon, they might not be making any money, but
Hmm.
somebody else is buying from them. So as a trader, you can still make money.
Yeah. Yeah. I mean, they're
So,
greater fool theory.
yep. So
Yeah.
now we've got this onslaught of new people pumping money into the system, making trades. We are starting to see some, I guess, improved efficiency as we're starting to move from utilizing brokers and being able to, or in-person brokers, and now being able to use online brokers. So
Hmm.
we've got just a very tumultuous time period that's going to happen. And there is a great film for anybody who's interested in called Floored, and it's about the
Oh, yeah.
transition of trading in person to trading online. And this was all started during this time period. Algorithmic trading started going. One
Oh,
of our
yeah.
buddies, Ben Van Vliet, he was on the cutting edge at the time for starting into algorithmic trading. And he did everything in VB.net at the time, which we would never think about doing.
No.
So all of a sudden, we see quite a bit of uh, what is it, drop from 2000 to 2001, and this is prior to the attacks on 9/11. Eventually, from September of 2000 to October of 2002, we saw a drop of 78.4%. So it's not nearly as dramatic as that one day free fall of like
No.
Black Monday, but this is substantial
Yeah.
over a
So
two-year period.
I, we're on a program together where a dude always likes to put us on the spot. I'm going to put you on the spot, and you can just give me a roundabout guess. If you're down 78.4%, what do you got to make to get back to break even?
160%?
360.
Oh,
If you're down 50, you got to make 100.
yeah, yeah, yeah,
So if you had $100 and you lost 78%, you now have $21.60.
yeah.
You need a massive return on that to,
Mass.
to get back to 100. And that's why it took 16
I was
years.
just going to say, and
Yeah.
that's where that comes from.
Yeah.
It's just insane. So again, put things in perspective, we had this weird long period of almost gluttony that happened. And then we had 2 years of pretty bad economic times. So we started with Sarbanes-Oxley. We had to put things in to create safe havens, or not safe havens, but for downside protection.
Mhm.
Further downside protection with Dodd-Frank. But Sarbanes-Oxley, it's at least for me, my big takeaways were the accountability of CEOs and CFOs. So now we had situations where we had changes in board structure. So prior to Sarbanes-Oxley, if I'm a CEO and I'm going to be evaluated by a group of people of the board of directors, well, I'm going to put all my friends on there, right? And I'm going to pay all my friends $1 million a year because board of directors get paid. And I'm going to pay them all quite a bit of money. And I'm going to say, you're going to tell me that I'm doing great and that you're going to improve my big paycheck, right?
Yep.
And now, after Sarbanes-Oxley, we have stricter regulations about having what's called independent people on your board of directors so that we don't have this kind of problem. We now have rules where the CEO has to sign off,
And the
uh,
CFO.
and the
I
CFO.
just I just happened to teach this yesterday. So
Okay. Yeah, no, I get it. Yeah. But you physically sign off on these things.
yeah.
We also created rules surrounding day trading. And again, I fully believe in free markets, but
Mhm.
as things have changed with day trading and retail traders getting into the markets, there has to be some kind of protection around
Mhm.
them. One of the things that we've talked about is firms that allow you to trade fraction of shares, which allow you to get more easily into the market because
Mhm.
it's cost prohibitive, but some of the dangers around surrounding that type of activity. So people that don't have the financial stability to actually trade these are participating.
Mhm.
We also Sarbanes-Oxley, and this comes directly from the Sarbanes-Oxley website.
Mhm.
And they're looking to establish confidence in the market. So you got to think after Enron happened, WorldCom and Farmar, we didn't talk about Farmar, but
Mhm.
Farmar was fun. What they did to trick people is they would take their inventory.
Hmm.
and they would ship it to from one warehouse to another warehouse in front of the auditors, or like ahead of the auditors. So the auditors were essentially counting and recounting the same inventory, but like double, triple, quadruple counting it. So, yeah, and again, goofy scandals like this, we need to reestablish confidence in the market. We now have to do financial controls. Let me see what else. And this is because I think that's it. Um, but I'll tell you very quickly what one of the things I had to do as somebody who was recently graduated. My job was to create all these rules and regulations and procedures in the accounting department and IT. So
Yeah,
at the
a lot of
time,
people don't realize that, yeah.
it was accounting slash IT. So
Hmm.
I was in charge of doing not only some of the books, but I was in charge of doing all the daily backups, storing the equipment for it, taking care of the equipment,
Hmm.
which is now in retrospect, I would not hire me to do any of these things. But
Yeah.
that's what was done.
What, did you do
25
it
years.
correctly?
I did.
Then they
Lightning.
hired the right person. Move forward.
Well, and it was funny. The machine it used a physical tape,
Uh-huh.
and Ghostbusters is my favorite movie. So
It,
you put in the tape, and the green light would show up. I said, "Light is green, trap's clean."
so,
So we all of a sudden had all these rules and regulations are surrounding these things.
yeah.
Um, and it applies to publicly traded companies. So if
Hmm.
you are not publicly traded, these are things that you don't necessarily have to follow. It's good practice to follow. And if
Hmm.
you're looking to become publicly traded, it's worthwhile to start these processes and procedures, but it's not required. And that is our discussion on the .com crash. I'll be curious to see what happens with AI.
AI, we're talking about this, but there are a lot of similarities. There may be some differences. A lot of what was being done on I continue to think about this one a lot, but a lot of what was being done on the internet in the AI bubble was consumer oriented. Most of this AI stuff really is corporate.
Mhm.
But the thing is, I just don't think it's as scalable as coming up with something that everybody, that 300 million people do online. Yeah. So that you hear the AI thing really focused on, how it's going to improve operations, et cetera. The AI probably could have done your function back in the day. But, as far as being a blockbuster consumer product, I'm still not necessarily seeing it. And I get a bit concerned about the amount of money that's being spent. But where's the money going to come from to pay for the money that's being spent? I'm just not seeing it right now. So
And a handful of companies probably will come out
yeah,
ahead, just again, like Amazon, behemoth of a company right now, right?
Google seems to be doing a great job with it.
They do.
Yeah,
So a handful of companies probably will come out ahead, but that doesn't mean it will be for everybody. And
no,
there are a lot of companies pumping money into this. With that, we
fact.
hope you appreciate this video. We thank you for hanging out with us. If you like this video, please hit like. And if you haven't already, please subscribe. Thank you.